welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com.
Yes, so hello and welcome to the next instalment of Nucleus Insights, which we've entitled GFC 2.0, or the Italian job. You'll have to excuse me, I've come down a bit of a cold in the last couple of seconds since you heard me previously. So, but anyway, we'll carry on, and I'll hopefully let the other two fine gents on the other side of the room, or the other side of the table here, David and Damien, do the rest of the speaking. So we thought we'd put this together, given some recent revelations with the rise of the five-star movement and league in the Italian politics, or the political spectrum, and of course the dire possibility that Italy may now join England in this fight or thoughts about leaving the EU. So we'll jump into the agenda. So today we're going to be looking at it less from a political standpoint, although we'll touch on that at the end, and more from an economic and also, I guess, an investment standpoint, which is what we do every day at Nucleus Wealth. So we'll be looking at the broad fundamentals of the Italian economy, some underlying issues sitting beneath the surface in this interesting situation they've got themselves in, and as mentioned before, then having a little follow up with the political side of things as well. So, with no further ado, I'll invite David to step in first on the fundamentals in the economy. Excuse me, in the economic sort of standpoint. Go ahead, David. So,
thanks, Tim. So we'll just kick off by running through some context on how Europe is travelling at the moment. It's come off an excellent 12 months, but it's kind of running out of petrol now. After the Chinese sort of semi-correction of 2015 that dragged down a lot of European growth as well, we had a lot of stimulus, fiscal and monetary, hit the globe. And there was something of a restocking event, which meant that the globe's factories all went like the clappers for 18 months to replenish inventories. But that's run its course, and thus European growth is kind of rolling back into its chronic slow state.
Sure.
So you can see that in this first chart, which is GDP growth. What have we got there? Europe versus
the US.
The US.
Yep, GDP.
And if you were to overlay that with the PMIs, you would see that they are leading European growth lower. And in fact, if you look at some indexes of sort of financial conditions, it looks like European growth is headed back towards 1% in relatively short order. So we'll go through these relatively quickly because there's a fair bit of stuff.
It is excuse me, it is quite chart heavy today, so feel free to be in touch for the chart pack if you're listening in as opposed to watching.
So here we have a second chart, which kind of, it starts to hint at the political problems that will be at the basis of today's discussion, and that is its unemployment between Germany and Italy. Obviously, the German labour market is going like the clappers, whereas Italian and other peripheral country labour markets, although they've recovered, remained extremely slack. So moving on, that's resulted, or is certainly a key input into what we have here, which is just chronically low inflation, very low inflation across the EU. Again, it's stronger in Germany where utilisation is much higher, but there you have it, very weak inflation. The ECB is still hard at it. Many people, the consensus now is that the ECB will begin to roll off a lot of its...
Okay, so QT as opposed to QE?
Yes.
Quantitative tightening, that is?
Yes. Its bond buying will slow and then reverse. However, I've never expected them to ever get that far.
Sure.
And it seems to me, very likely that they'll be forced to retrace on that, owing to the Italian crisis. But at this point, at least, those purchases are on the verge of slowing.
Okay.
And so, the euro, which has been on a tear for sort of late last year and early this year, was based, on the notion for markets that interest rate spreads were going to converge between Europe and the US and other jurisdictions because it was recovering so well.
Sure.
And the ECB was going to roll off and then start raising interest rates. However, that's now been completely shot to pieces, and the euro is now falling, the last few days off a cliff, but it's been falling now for a month or 6 weeks or so, and I can only see that continuing as the ECB is forced back. If you move to the next chart, you'll see that despite a sort of month of 6 weeks of very weak euro,
sure,
markets remain almost hilariously long.
Okay.
Europe, and have clearly been caught on the wrong side of the boat in reference to this crisis.
Okay.
Currency markets especially got very bullish on Europe over the last 12 months. They weren't reading MB, obviously, and have been blindsided by the slowdown. And the pullback of those positions has only just begun, even though the euro has crashed probably, 10%, approaching 10% already.
Yep.
They're still very, very long. So the fact is that if the Italian crisis persists and European growth continues to roll over, as appears to be the case, then there's still a long way to go to correct the euro long in markets. How far it could fall, I don't know. It's about 1.16 today to the US dollar.
Yep.
I was expecting it to go back down to sort of 1.10, but that was pre-Italian crisis, so all bets are off now.
Okay.
If that chart were to fully invert and we were to go back to a massive euro short position, then parity could easily be threatened.
Wow.
I think. So at this point, I'll hand you over to Damo.
Yeah, sure.
He's going to tackle some of the EPS stuff.
Okay, sure thing. Welcome, Damien.
Thanks, Jim. Yeah, so just talking through some of the where markets are, where stock markets are, is just got some corporate earnings numbers up. So corporate earnings sort of followed the GDP data and was on a tear as well. So this is a relatively long chart we've got up there, but basically it's sort of showing that it went through so post the financial crisis, earnings sort of fell almost 50%, and then there was some recovery, but then just stagnation for a long period of time, for 4 or 5 years of just sort of sideways to down earnings. And then the last maybe 12 to 18 months, it took off, and we sort of solid signs of growth and companies reporting positive earnings.
Sure.
But in the last maybe 2 months, that's turned.
Okay.
So we've seen So from an earnings perspective, what looked very good 2 or 3 months ago is now certainly rolled over, and potential that it could certainly roll further. And then from a valuation perspective, we've sort of got three different charts. The US, the Eurozone, so basically any countries that are actually on the Euro.
Yep.
And then the Europe ex Eurozone, which is all the sort of peripheral countries, like say England or Switzerland that are within Europe, but not actually on the Euro themselves.
And it's surprising to see there that it's less again than the Eurozone. Is there sort of some reasoning behind that?
Yeah, so well, from our perspective, I guess what we're looking at is that the US is certainly more expensive than Europe, but justified in terms of a higher growth.
Yep, demand. Yep.
Within the Euro versus the peripheral Euro, that's where we think there's a pricing anomaly.
Okay.
Is that we're not particularly enamored with the growth within the Eurozone. If there are other issues in terms of Italy at the moment, then there's certainly downside to the valuations. So,
Okay.
so you're cheaper than the US, but some reason for it. You are more expensive than peripheral Europe, and we like the prospects for peripheral Europe better for companies within that.
Okay.
But it is worth noting that from a market's perspective, while things have sort of just turned a little bit now, we've started going through our Italian shopping list, so to speak.
Sure.
Certainly way too early for us to be looking at buying stuff, but if it does sort of devolve into a crisis, you want to know now. You want to be looking at the companies now and getting a list of, okay, here's good quality, solid companies that I'm interested in buying, and if the prices get smashed and the euro falls, then
Buying opportunities.
Exactly.
Yep. Okay. Sure.
You're not sort of going to try and pick the bottom out of it, but we're certainly it's way too early to be jumping on these now. But you do need to have your shopping list ready to go for when the sale happens.
That sounds smart. No problems. Okay. Very good. And looking then, so this is just a quick
chart just to sort of show for anyone who's looking countries that are within Europe but outside the Eurozone.
Okay.
Sorry, yeah. There's Denmark, which is largely fixed anyway, but then you've got your Sweden and a number of sort of Eastern European countries there that are within the zone but not.
Yeah,
sorry.
So they're friends, but not family, so to speak.
Yeah, similar to England. So what it does mean is that they've got a currency. The currency can actually adjust for differences.
Sure.
Which is one of the leads sort of into this next issue that we've got. So we sort of set. That's roughly where we are at the moment.
Okay.
There's the second part we wanted to talk about was what are the underlying issues within Europe. So we've sort of got the very short term stuff. In our view, these underlying issues is the long term things that need to be solved with the euro. Now, when the euro was put together, it was done as it was acknowledged that it's not a complete. It wasn't sort of a one stop. We're done. We don't need to touch this again.
Okay.
It was sort of as an initial step because it's got three major issues with it. First is you want a common sort of political and fiscal transfer. So within countries, usually what you have is when you're in the single currency, usually what you have is that you can taxes get transferred from one area to another, and liabilities get transferred. So if you're in, say, the US and there's some underperforming states, then some of the better states can be transferring money and paying for the unemployment benefits in the states that aren't going so well, and vice versa when the issues flip around. Now that is not the case within Europe. You don't have that sort of transfer. You
haven't got the ability to devalue.
Yep. The second thing you usually have within currency zones is a high degree of labour and product mobility. So basically, when you've got one area of the country where unemployment is high, people can move from there to other areas. Now that they can do that within Europe, the thing is they don't.
Okay.
And the joke, and it's probably not so much of a joke, is that it's pretty tough to get people to move villages within Europe, let alone move entire countries.
Yep.
And because you've got so many different languages spoken and things like that, it's obviously a lot harder for somebody in Greece, for example, to move to Germany and in search of a new job.
For a like-for-like experience, I guess, essentially. Yeah, or a lifestyle. Yep.
Yeah, and then the last part is that joint debt monetisation. That each you've got the debt between different areas is sort of jointly accountable. Yep. And so they're the sort of these key issues that happened when the euro was put together, with the view that when a crisis happened, that would be the impetus for the euro to move closer together, and maybe move to a single taxing system or things like that. Or
yep, and that's sort of because I was just sort of prior to this was having a bit of a read up, and obviously one of the key tenets of the EU was an ever closer union. I think was the term that they sort of chucked together when they put all this together, and then sort of post the GFC, it's sort of become a case of the haves and the have-nots, or the creditors and the debtors.
Absolutely, and that is that big issue. That the first one I've got down here is that being within the euro means you can't restore your competitiveness. So if you're a country which where wages are too high, so let's say it's somewhere like Spain versus Germany. So Germany went in with quite low wages and with accords, so sort of deals that have been done with unions to keep wages quite low, and so German wages very low. And so that means they're producing a lot of goods, high employment, producing a lot of goods, and then pushing those. Then somebody needs to buy those goods, and so they've been offering the credit effectively to Spain and letting Spain buy those goods. And
yep.
And so on one side you say, oh, Spain, you shouldn't be going into debt to buy the goods.
Yep.
On the other side you're saying, well, just a minute, you're the same country offering us the debt to buy your own goods, and so. There has to be some balance on both sides, and wages in Germany need to rise.
Yep.
Now, if you're in a different currency system, it'd be very easy. The Spanish currency would devalue.
Yep.
And now that'd even out wages versus Germany, and it would even out any price differentials, and people would then start producing more stuff in Spain and less stuff in Germany. The issue is we haven't got that, and so what it means is wages in Spain need to fall, and what you need for that is they need to go through a depression level unemployment until wages gradually get down to the level that people will switch to Spain.
That sounds pretty dire.
Which is that's exactly. It's not an easy way. There's an easy, where the currencies are nice and easy, nobody really notices. I keep getting paid what I'm getting paid in my own currency. It's just that.
It's got a sort of an automatic stabilizer sort of effect built into it.
Absolutely.
Yeah,
sure. So the big underlying problem is these countries are stuck in this euro straitjacket. Then we start to go, oh, well, what does it actually mean in terms of some of the underlying issues? And I might flick back to David to sort of run through some of the other issues you see in terms of the debt and inequality and things like that.
Yeah, sure. Okay. So just while David's getting ready, so we're going to focus on the debt first. Is that right? We'll have we've got a chart up here, a couple of charts up here on some comparisons to Greece, obviously well-known debt problems throughout, post-GFC, and now it appears that Italy's in a similar boat.
Yeah, well, I mean, obviously the implication of what Damo's just described with the euro straitjacket and the inability to adjust externally is political. Because if you've got to be in a permanent depression to correct your real exchange rate, then your politics is going to suffer.
Absolutely.
And you're going to get revolutions and whatever. So, that's kind of what transpired in Greece as Germany kind of turned the screw on it and expected it, in 2011-12 to deflate itself internally. And the only reward for Greece in doing that was actually more debt.
Mm.
So they would do these austerity deals where government spending would be cut, to push along wage deflation, to try and correct the external imbalances, and they'd be rewarded by more and more debt. Which just is an extend and pretend operation that eventually, did result in a primary surplus for Greece, but that doesn't include the interest on the debt.
Sure.
But the debt just keeps ballooning out, and so you really just
at depression levels.
Yeah,
and everyone suffers essentially.
And everyone suffers, and you're really going nowhere fast.
Sure.
And so now, we've if you want to move on with those charts.
Sure. Yep.
So what we're really describing here is an inequality across the Eurozone between, the northern austere nations and then the southern beachcombers.
Yeah, spendthrifts.
Yeah. And there's also inequality issues within countries.
Sure.
So you tend to find the elites of the countries that are under pressure are much better off. Sorry, hang on a sec.
No, hang on.
Yeah, so and as part of that, Germany's a great example. There's a deal done to keep wages quite low within Germany, which was good in a way for the German worker that they've, they started at a low base, they get to keep lots of jobs and all those types of things. But it's obviously much better for the people who actually own the companies and get to keep their wages low and make all these profits selling their goods to other countries.
Okay.
So, that creates these, not only do you get there's a Germany versus Greece issue, there's also within countries, you're seeing a big divergence and a lot of the quantitative easing and markets going quite well, no inflation in Main Street and lots of inflation on Wall Street type thing.
Yep.
Which bids up the price of assets, so it makes the wealthier wealthier, and so you get more tensions in these, not only between countries but within countries itself.
Within them as well. Yeah, sure. Okay.
That's right, and just pushing back towards Italy now. If you move on to that next chart, you'll see that overlaying this again, and some might even argue driving it, is demographics. In Europe, Europe has some of the world's worst demographics.
Yep.
In terms of ageing, and Italy is almost the worst in Europe.
Yeah, okay.
As well.
Sure.
So coming back again to the tensions within the countries, a lot of the elites try to address this through immigration, which has become a key kind of lightning rod for the class wars that we're beginning to see emerge.
Yep.
And so, immigration has become part and parcel with this building revolution against the euro, where you get imported cheap labour by the elites, trying to backfill some of this demographic problem.
Sure.
And, so there's lots of African workers, working on the cheap, boosting profits across Italy in the agricultural sector, for instance. But then there's a lot of anger at falling wages.
And I guess pressure on social services.
And some of that
added costs.
Some of that is obviously reminiscent of Australia.
It doesn't sound too far off.
And so you get this convergence of issues in Italian politics now, where both the mass immigration into Europe and in particular Italy has merged with the constraints of the euro.
Sure.
And the eurozone. And so bizarrely, that's created this revolutionary environment. If you want to move on to the next chart there with
no problem.
Moving into politics now, where you've got the left and the right coming together, extreme left and extreme right in MS5 and the Northern League, because both of them are, from opposite ends of the spectrum, object to both the immigration solution and to the constraints of the euro itself. And so, maybe to put that into context, we'll just pop back into a bit of time and have a look at how those tensions have been handled to date. Go back to the chart.
There we go. Yep, there we go.
Yeah, so I might just give you a quick... we want the politics.
Okay, sorry.
Yeah. So just to put Italian politics into perspective, so you've got a president whose job is to uphold the constitution. So the Sergio Mattarella, who's president until 2022, when he's going to be 80, and so he's quite he's very pro the euro and keeping Italy within the in the eurozone. You had a few years ago the prime minister was deposed by the president, or I guess he left his post, and it was an EU-led appointee, which was Mario Monti. So was installed as he hadn't been voted in, so he was just installed as a technocratic prime minister. And so that was in 2011. He was basically PM for about 2 or 3 years, and then ran again in 2013, where he got 10% of the vote.
Wow.
So is obviously not you've gone from an unelected person to running the country, and then when that person came up for vote, he only got a very small proportion. Now, rightly or wrongly, look, we're not making judgment on this, but what we're doing is flicking back to, if you're in a country and you're voting for people, and then the European Union is stepping in and sort of strong-arming into a different person to run the country, which is sort of where they're starting to look at the moment, then then there's obviously that leads to further discontent. So what we've had is the 5-star and Liga, as David said, voted in with roughly 50% of the vote
This year.
This year.
Yep.
They went to form a government, and their finance minister is anti-euro.
Okay. Yep.
And the president stepped in and said, no, I'm not allowing that to be. You can't form a government with this guy as finance minister because he's anti-euro, and my job is to uphold the constitution, and I think you're trying to pull us out of the euro.
Yep.
And so it's an interesting question about freedom of speech and things like that, and whether one person as a finance minister in a cabinet can mean that the whole government and 50% of the people's votes that went to voting this coalition in are invalid, and that's where it sort of left us in terms of this. You're now stuck in this this
Twilight Zone
this bit where do we have technocrats that have been unappointed by, or haven't been appointed by the people and not in a popular vote, who are then running the country, or is it a popular vote that run, and how much discontent will we get? So there's a lot of issues within that, and whether that then where does that leave the Italian economy, and where does it that then spiral into crisis?
And
so I mean the key point come out of that is don't forecast Italian politics. Like it's it's chaotic at the best of times. And right now it's in complete flux.
Sure.
But there are sort of clear, there's a clear battle going on, as Damo says, between democracy and technocracy. But within that, there are all sorts of possible outcomes. When you have the populist, so-called populist guys who in some ways actually make a lot more economic sense, coming together in the way they have with so much of the vote, it appears that they will be very difficult to stop in getting their platform up, which is basically to do a lot of fiscal stimulus, everything from tax cuts to universal basic income.
Okay.
And that flies in the face of all of the constraints that Brussels or the EU places on the Italian budget,
which is generally fiscal discipline.
That's right.
Large S.
And so. In effect, you have this revolution in Italy versus Brussels or perhaps Berlin, more to the point, and the latter will try and destabilise Italian democracy to the extent that it will prevent it leaving the euro or violating its rules. Now, the EU has very, very little history of being able to compromise on these things. It's very difficult to foresee how it can come out of this with fiscal solutions.
Sure.
The ECB can come in and support, Italian debt at certain points if it gets really out of hand. It said last night it wouldn't because it was such a short-term crisis, but it can. The issue is, does Italy want any of Europe's help? What it wants is basically debt forgiveness, which the EU will never give.
Yeah, sure.
And it doesn't want the ECB support because it's the very same extend and pretend, slow draining of the country that Greece went through. That's what the populists don't want. And so the issue is, how much credibility, how much motivation do they have to push the country through the pain, to put it on a sustainable footing outside the Eurozone, or, will the elites, which hold a lot of the Italian debt themselves, prevail and hold it within the Eurozone? But, it's very difficult to know who's going to win out at this point.
Yep.
And actually, a quick comparison back to Greece is that there was some. There was with Greece, because it was such a small country relative to the rest of Europe, there was more chance for the euro to put pressure on Greece and to make them feel some pain. The issue with Italy is if you start trying to make Italy feel too much pain in terms of higher bond yields and things like that, because it's such a large part of the euro, especially from a debt perspective, you could put the whole
Destabilise the whole.
Yeah, you could. With Greece, you can sort of go. I think the view is yes, we can put enough pressure on them because we're pretty sure we can put the thing back together afterwards. Whereas if you start getting major issues with Italy, you quite possibly wouldn't be able to put it back together.
And you think the question
basically it's too big to bail and too big to fail.
And that's the problem, though, isn't it? That at the end of the day, the EU's really just got this one lever that they can pull, and it doesn't seem to be any other option.
So if you want to move to that next
yeah, sure.
last
Actually,
chart.
just before we do, we've got a question here as well. I might do that just before we have our last chart to finish on, if you're happy with that. Which is, why does MB believe that in the event of a euro crisis, the AUD will depreciate and not be in demand, or at least stable, as one of the recognised internationally traded sovereign currencies?
Well, we'll answer that question with this next chart, actually.
Oh, okay.
So if you want to bring it up. I mean, the way we handle so much uncertainty in something so critical is we do scenario analysis, basically.
Sure.
And the way that we're seeing this is, a chronic grinding crisis in Italy where, God knows any new political party might emerge. Brussels may succeed in dividing MS5 from the League. They can't form government. There might be new elections. There might be someone new parachuted in. There's just myriad possibilities.
Sure.
And so a chronic crisis of that nature, to my mind, makes the euro uninvestable.
Okay.
Because you'll have the constant sort of Damocles hanging above the euro, where Italy could just fumble out at any given moment or not. And the key point of that here is this chart, which is where you have a list of national banks and their exposure to Italian debt. And this is why Italexit or Quidly, whichever you want to call it, is such a big deal, is because there's a lot of money owed externally by the Italians.
Sure. Yep.
And if they do stumble out of the euro, then their new lira will collapse in value, and there'll be a default on all of this dough, and an awful lot of it is owed to France and German banks. And so that means you'll get instant kind of counterparty problems across the global banking system, and contagion will run wild in global banking. Very much as an action replay of the GFC. Only this time perhaps worse, because you'll also have any number of sovereign nations, liquidity and solvency questioned simultaneously. So why is that's the chronic case. The acute one is where the Italians simply do slide out of the euro and trigger all of that crisis immediately. And that can happen if, let's say, MS5 and the League do go to a new election.
Yep.
They get in. Italian bond yields spike again, and in order to pay their liabilities, they issue this new mini bot that they've got, which is like just a new sort of strange sovereign bond.
Okay.
Which is effectively the beginnings of a new currency. And so the more they issue that to pay their liabilities, the less people want to buy Italian debt, and you de facto just slide out. And then all of a sudden, all of those debts that are owed to the banks overseas will be paid in new lira, and nobody wants it. So you'll have effective defaults all over the place. And if that happens quickly, then you'll end up with a very acute shock.
Sure. Okay.
So why would the AUD fall in both of those cases? I think they're actually bearish for the AUD in both.
Okay. Is that a confidence, just a general confidence thing, or is that?
That's a certainty.
Yeah. Okay.
Well, certainly in the acute scenario, it's a certainty.
Yep.
in the chronic one, you might be able to argue that there are offsetting factors that could hold the AUD up. But basically, if the euro is under existential threat, then, capital flows are going to go to the US dollar.
Okay.
Almost by default, the US dollar index will rise because the euro is such a large component of the US dollar index. So, that means there's downward pressure on everything that's on the opposite side of that cross. So that's one headwind. But the AUD's held up against that quite well in the last few months.
Okay.
But the longer the crisis goes, or the more acute it becomes, which may be the same thing or may not be, and the higher the US dollar goes or the lower the euro goes, the more pressure there is across the world on US dollar denominated debt and assets. So that will then start to hit emerging markets as all of their US denominated debts get more expensive. That means a lot of monetary tightening across the emerging market world, including China.
Okay.
And of course, all commodities are priced in US dollars. And if you combine capital outflow in emerging markets with
rising resources.
Then you end up with lower commodity prices as well.
Okay.
And that's basically the case why the Australian dollar falls. So basically, the AUD is a risk currency.
Okay.
When there's good growth, it goes up.
Yep.
When there's bad growth, it goes down. And those things get exaggerated by the degree or role of commodity prices within that paradigm.
Okay. And I'd also add to that, along very much the same track, is that when global growth is strong, sort of 3-4%, then the Aussie dollar is rising, and when growth is weak, it's falling. It's basically on the basis of a commodity demand. When global growth is sort of 1 or 2%, then commodity demand is quite low, and that sort of hits the Aussie dollar. And as David said, it's very much a turbocharged play on world growth.
Okay, yep, sure.
So anything that looks bad for growth, I think the key bit, what's your key scenario to say how can Italy get out of this and everything go back to normal? To me, really comes back to the politics of the Italian people. So if you can get the Italian people to vote for a government that is pro-Europe and happy to keep going with 11% unemployment and gradually tweak it down to 10% over the next few years, and hopefully back to, maybe only double German unemployment within sort of 5 years, then resolution and thing goes, or not long-term resolution, but certainly short-term resolution and things go on as normal. The real question for Italian politics to be watching over this next period is, do the Italian voters sort of go out and almost push more towards these parties to say, well, you can't keep putting unelected people in charge of our country. We actually want to say in this, and if we will vote these other sort of protest parties in, or do they see the rising bond yields and problems and all these concerns about Italy possibly leaving and sort of flee back to some of the more traditional parties that are pro-Euro?
Yep. Okay. Sure.
So that's your key question in terms of, do you end up in a chronic crisis, an acute crisis, or do we just go back to the same
bumbling along,
same grind? Same.
Okay, sure thing.
And
David,
I'll just add to that. I guess in terms of market action, in sort of wrapping up chronic versus acute. Either way, whether it's chronic or acute, this is going to play into end of cycle dynamics. With the chronic one, it may be that the global business cycle can see it off. Maybe the most of the growth effect is in Europe.
Sure.
But it probably would see European growth fall down towards 1%, which would be quite troubling for China as well, because they have a lot of exports.
Absolutely. Yep.
You got to factor in the way various kind of large economies are going at the moment. So Europe slows and China slows. The US is not terribly exposed to European exports, and so it keeps going. And so what you have then is an amplification of, what's happening right now, where US is leading global growth.
Sure.
And so what that means is Fed tightening continues, maybe slows a bit, but continues. All the yield spreads again favour the US dollar.
Yep.
The US dollar keeps going up. even more as the euro chronically falls down, and that starts to pressure a lot of emerging markets, as we've already just discussed. And so, one basic thesis for how we end this business cycle is Fed tightening simply goes, one too far at a certain point, and US corporate debt spreads start to blow out, and the stock market
begins.
unwinds, and you get your classic kind of end of cycle shock arising from Fed tightening.
Okay.
And the chronic euro scenario actually emphasises that as a greater possibility.
Yep. Okay.
And so that's one scenario in which it exaggerates, a Fed-ended cycle. And then second, the acute crisis sort of speaks for itself. If Italy does kind of tumble out of the Eurozone, you end up with banking seizures worldwide, then you'll simply have a rerun of the GFC style shock, and it'll all just happen a lot more quickly.
Sure thing. And Damien?
And it's also worth noting, so post the financial crisis, we had the shock where the pigs, as they were called at the time, was whether would Greece last, and issues about Spain and issues about Italy, but Italy was sort of further down on the list at the time, and Portugal as well. I think the one of the key issues is that if Italy does drop out of the euro, there's be big question marks then on a whole range of other countries, and whether the whole thing, that's enough of a domino to fall to spark a number of issues there. It is also worth noting that equity markets fell about 20-something%, depending upon where you were, a bit more in Europe, a little bit less in the US, during that next set of that crisis, which was sort of around the 2011. So it wasn't it was post GFC. Markets had recovered somewhat, and then the European crisis, even though it didn't end up, it ended up being resolved papered over. Resolved is way too strong of a word. Papered over and the can kicked further down the road. Is that even if we do end up with a scenario where the can does get kicked further down the road, if we sort of end up in a more of a short-term crisis, there is some significant downside you could see to markets.
Okay, sure. And I guess, go on, sorry.
And I do think, as David said, that our view about it being the most likely outcome as being a chronic, which is, look, the ECB and Europe does come up with another solution to keep Italy there and happy and all that type of stuff. But the chances are it's not a solution that evolves overnight, and it's not a solution that evolves without at least a decent shove from markets, whether it be debt markets pushing the value of Italian bonds up, or whether it's equity markets taking a tumble, and probably both.
Probably both. Yeah.
And that is what I was saying about us getting a shopping list together of things that we would like to buy in Europe if the prices fall far enough that it justifies the lower growth expectations.
And just while we're on the thought of the portfolio, so is there anything we're sort of doing now outside of that, preparing for the what if scenario when prices fall?
Yeah, we've been lightening up on Europe for a long time.
Okay.
But that wasn't because we've
foresee this one.
Foresaw exactly what the crisis was going to be, but we knew that the euro was expensive, and that was making an effect on growth, and there was a lot of positivity around over the last 18 months that quite frankly we thought was well overdone. Like it was
unfounded.
It was just that we do think there are chronic issues, and those underlying issues we spoke about in Europe haven't gone away. So our view was that Europe will have 18 months in the sun, and then it's on to the next issues, and you start seeing growth slow down and the underlying problems emerge. Now, can the can get kicked further down the road? Quite possibly it can, but probably we need another mini crisis or a mid-level crisis for that to happen, and off we go again, and that's just that chronic rolling series of will they leave, won't they leave? Are these things fixed? Aren't they fixed? And generally, we're not fixing root solutions. We're just trying to work out how to paper over the cracks long enough to let the next guy sort it out.
Oh, and when there's volatility, there's opportunity. So
I'll just add that the key sector that's in the gun or to avoid is banks.
Sure.
As Damo said, in 2011-12, the stock market took a pretty healthy hit. But within that, the banks were hit hardest. simply because, as you can see from these charts, that banks are at the coalface of the crisis. In terms of resolution, it's all about defaults and deleveraging and balance sheets.
Sure.
And so that means banks worldwide tend to fall, and Australian banks get drawn into that as much, if not more than most, because they're still 40% offshore funded. A lot of that is European derived as well.
Okay.
And so you have, we already have short-term rising funding costs on, some are arguing the Fed, but we think it's more the Royal Commission. But what Europe does essentially is raise long-term funding costs as well. So, Australian bank profitability will be very troubled through either of these scenarios, but including the chronic one.
Okay. So, as always, banks are always on the nose. I was actually fascinated on this, just to finish off with the exposure of the French banks to Italian debt, which is, it's easily over half, which is, given this this chart here.
Yeah. Well, that just gives you a sense of why it's difficult to resolve from the perspective of the core of Europe, because even if they want to write off some of the Italian debt, to do it, they have to trash their own banks. So, these core governments have effectively got to recapitalise their own banks to let Italy off the hook. And, obviously that comes with all sorts of
a big task,
political difficulties. Yeah,
sure.
But and that was effectively, in a way that was the quandary that was put to Ireland when Irish banks were. Looked like they were insolvent, and the best thing would have been from a country perspective, the best thing for Ireland would have been to say, well, our banks are insolvent, they made loans they shouldn't have made. We'll start. We'll take the shells of the existing one, and everyone takes big losses, and on we go. Whereas they ended up bailing out their banks, which was effectively saving the German banks in particular.
Yeah. Okay.
So a lot of arm twisting there to say, well, you need to take one for the team. You guys need. We made loans we shouldn't have made, but we want you now to make good on those loans. And so that's a problem that is going to happen here. Is there's going to be a lot of arm twisting and a lot of behind the scenes machinations that nobody will ever see until sort of 10 years down the track. But
Okay, sure thing. So on that note, we'll hear a little bit more now about investing with Nucleus Wealth.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Well, I certainly hope you enjoyed that. Sorry, a bit of light construction work going on in the background there. I certainly did. And stay tuned for our next instalment of Nucleus Insights, the state of the nation. So we're going to get our resident economist in, Leith Van Onselen, who's rapidly working through at the moment the national accounts. And so what we're going to do is just bring you through a presentation on how Australia is looking from an economic point of view, but of course plenty of charts and plenty of interest in there. So if you'd like, head over to proton.nucleuswealth.com to register your interest on or in the state of the nation, and that's of course in our new office on the 7th of June at 12:30 p.m. As always, we are available on any major podcast provider, app or website. iTunes and Podcast Addict for anyone on Android has been offered. Just search for Nucleus Insights or Nucleus Wealth, and you can check out everything we do through our webinars, of course, as a podcast as well. And just finally, as always, Maddie, our communications expert, will be sending through our surveys, in which case you can give us a bit of an idea of how we're going at the moment, rate our performance, but also offer up any potential topics for future webinars. So on that note, thanks very much for listening, and we'll catch you at the next one. Cheers.